I'd like to welcome everyone to the first lesson in the Market Profile Beyond the Basics course. Hopefully everyone here with us in the course today has some background or at least some familiarity with the market profile and the concepts. We are going to be moving at a somewhat accelerated path, and we are going to be looking at how to actually apply the market profile concepts in this course. And so it is important for everyone to have at least a basic comprehension of the basics in order to be able to follow with us how we are going to employ and apply these concepts. As usual, we need to review together the disclaimer. Trading and investing involve high levels of risk. Future results can be dramatically different from the opinions expressed in this course. Past performance does not guarantee future performance. The presenter may or may not hold positions in the financial instruments discussed. All right. A good place to begin is always with the introduction. And as I mentioned a little bit earlier, the market profile is in fact one of the most powerful analytical tools for the financial markets. It actually offers us a perspective of the market that is not available through any other tool or any other charting method. That is really where the power of the profile lies, in the type and the nature of the information that it provides us. Now, having information is always useful, but what is even more powerful than having the information is being able to capitalize and to use the information that we have to make better trading decisions and to be able to execute trades that are consistently profitable. Now, before we begin, I always like to go through a basic review of some of the key profile concepts that we will be using and touching upon throughout the various lessons. So today's lesson will be a brief review of some of these concepts. And then when we begin to use these concepts in our strategic trading process and in developing trading systems and trading strategies, we will revisit some of these concepts and we will look at them in even greater detail. But I would like everyone here with us today to at least be familiar with these terms and these basic concepts before we begin to navigate further. Everyone should really know what a value area is and what that really means in the market. Everyone should be able to identify and pinpoint buying tails and selling tails in the market. They should also be able to understand why these particular elements on a profile are important. Single prints are also very, very critical points on a profile. Volume points of control, and of course, regular price points of control or time points of control. The initial balance, another very important concept associated with the profile. Understanding what overdevelopment and underdevelopment means and what the implications of overdevelopment and underdevelopment are in the structure of a profile. Settlement, the settlement period at the end of the day session. And again, the implications of that period and how we use it to prepare for trading for the next day. Activity clusters, how we use clusters to give us an indication about the potential direction and the bias in the market. Ledges on a profile are also another important key element that we need to be able to look at, identify, and understand its implication in the market. Now, let's begin by looking at some general profile patterns and profile structures. And I like to begin with that before we actually take a close look at some of the terms that we've identified, because the patterns and the structures give us a very rapid view of what's going on in the market when we look at a number of profiles. And let me share with you what I mean by that. Here is a simple chart. The chart has basically 6 different profiles on it. It begins with a day session, followed by an evening session, another day session, followed by an evening session, and then another day session, followed by an evening session. Now, let me share with you quickly what this pattern tells us when we take a look at it. First of all, the first day had a lot of buying activity that pushed prices higher, and we ended up with a cluster or a P-shaped profile during the day. The following day, we ended up with another P-shaped, letter P like pear, shaped profile in the evening session as well. So this was the following session. So we had two letter P shaped profiles. The interesting thing is here, this letter shaped P, this is where we find the close. Here on the first P, this is where we found the close. So obviously, it immediately tells us that this cluster was selling activity that brought prices lower. In the following session, we continued to have a lot of activity in this area, which was again selling activity that propelled the prices lower, and we ended up with a lower low and a lower close. Now, before we actually take a look at the next 2 profiles, this shape, when we see it, should tell us immediately that the following session is more likely to be a negative or a downward session. And I'll take a look at exactly what happened in the following session. Period A and period B both push prices to the lower end, and we end up with a much lower value than we had up here. Now, interestingly enough, we begin to see a different shape profile now here at the bottom. In this case, it's almost an upside down letter P or a small letter B as in boy. So if you take a look here, the first letter B, we closed here within value. And then on the second letter B, this particular cluster, when it happened, obviously was buying activity because it sent prices higher, and we ended up with a close above the value area. So we should right away, based on this pattern when we see it, expect the following day to be an up day and have a bias to the upside. And sure enough, if you take a look at what happened on the following profile shape, we did go up and we moved higher. And now in this picture, we are continuing to fill the underdevelopment in the evening that occurred in the day session. By the end of this course, I am hoping that everyone in the sessions with us will learn how to interpret and understand these shapes and use them just as I have demonstrated to develop a bias, and then we're going to go into much greater detail once we have that bias. How do we actually build our trading strategy? How do we take our trading entries? And we're going to be looking at a multitude of different systems in terms of how to trade using profile concepts. Now, the next area that I'm going to highlight in our brief review in this first lesson is the value area. Anyone dealing with the profile and attempting to use the profile must have a clear and a coherent understanding of what the value area is, what it means, what it represents, and that will make it useful for them in their trading and will help them to structure around or using the value area concept. Well, the value area is a result of the statistical analysis that the profile presents to us. The profile is nothing more than a statistical normal distribution for market data. Now, once we have that, we take a look at the area where the bulk of trading activity took place, where about 70% within the normal distribution took place, 70% of the activity, and we call that the value area. The value area is really quite evident here as I will highlight when we take a look at the slide. It usually is bound by a line at the top and a line at the bottom. So this is the value area for this particular profile, which extends from here to here. This is the low end of the range, the high end of the range, and herein lies the value area. This particular range, or this area within the sessions trading day, constituted and made up for us the value area for that particular day. Now, the next session, which is an evening session that follows the day session, has its own value area. It just happens to be within the value area of the day session. And we will also learn what that means, what the implications of that are, and how different value areas from one profile interact with the other. But before we can really learn any of that, we have to, one, be able to identify the value area, two, understand what that value area means. That value area is really the area of the greatest level of activity, or the area of price acceptance, where sellers and buyers really thought this would be the best area to trade. And there was a lot of transactions taking place. Certainly the majority, 70% of the transactions for the session took place within that value area. Once the session concludes, we have what we call a value area high, which is the upper boundary of the value area, and we have a value area low, which is the low boundary. Now, one important fact about the profile, since we're talking about the value area, that we should immediately highlight, is the fact that some of the best trading opportunities will occur when price is outside of the value area. Well, we know that this is the area where the greatest level of activity occurred, but anytime we begin to see price, say, above value area, we should immediately realize that this is a potential opportunity. A potential opportunity for prices to continue to move higher, or possibly prices may in fact get rejected in this high range and get pushed back towards the volume point of control, this level that we see here, which we will talk about in just a moment. And possibly even it may drop all the way back down here for a test of the value area low. So whenever price deviates away from value, we should know that an opportunity presents itself. And our job, or what is incumbent upon us, is to determine, is the opportunity going to be to continue to move higher, or if in fact the price has deviated above the value area high, our price is going to continue to move higher, or our price is in fact going to drop and return to value. It depends. When the market is ready to move, it certainly will move and continue to move directionally. If the market is not quite ready for movement, it will return and it will stick and stay in the area where it is comfortable and continue to do what we call development in that area. Now, the initial balance, another concept we talked about a little bit earlier, and a concept that we will visit together extensively in probably one or two lessons, just focusing on it, because it too creates for us some wonderful trading opportunities. And I will be sharing with you some chart definitions to use for initial balance strategy when we get to that lesson. And you will enjoy those because they're easy to trade, and they can be quite lucrative. All right. It is important also to know that there are many different settings for a profile. Do not get stuck in sort of one type or one setting for the profile. There are, of course, preferences that we can adjust. And in this case, on this particular slide, I have the preferences set for the ES Mini so that I could see what happened in the day session, and then at the same time also be able to take a look at what is going on in the evening session. And it is important anytime we have a 24-hour market to be able to make that distinction and to know what the differences are between each of those two sessions. So that would be my overnight session, and there's my day session. Now, another important concept to recognize, and that everybody in this class should know from this point on forward, is the concept of a naked point of control. Earlier, I spoke of a volume point of control. The volume point of control, by definition, is that price point during the session where we had the greatest level of volume trade in the session. So greatest level of volume at a certain price, then that would be known as the volume point of control. Now, what if we have two different points where the volume is exactly equal? Well, then in that case, and the volume is the highest level for the session, but 2 points with that equal. We usually will take the one closest to the center as and use that as our volume point of control. That does sometimes happen, but it does not happen frequently. Usually there's a clear and distinct volume point of control. Now, we can also have what is known as a naked point of control. And a naked point of control is a point of control, as we defined, one with a great deal of activity, but one where the market has yet to visit. It has never been previously visited. As we see here, this naked point of control, we have not done any trading in front of it, and therefore it remains naked until, for instance, this session activity starts to drop down and trade into it. It will no longer become naked. It just becomes another point of control. So naked means the market has never really traded through it, and it is a point that has never been visited by a time price opportunity or a TPO. Hopefully everyone is also familiar with this nomenclature of what a TPO is, but just to quickly review and make sure everybody is on board, a TPO is a time price opportunity on the profile. All these letters that you see on the profile are time price opportunities. A time price opportunity occurs when the market visits a price level during a period during the session. The standard period on a profile for a session is usually 30 minutes. Now, once again, I mentioned earlier that we have a lot of flexibility, and we can certainly adjust and change that, and we will be looking at different time frame profiles together, and we will see why when we begin to change that around, it can be helpful and it makes sense, and sometimes our strategies will dictate for us what the settings ought to be for the profile. The volume point of control right here appears right here. So the important point that I want to illustrate or demonstrate here is don't look for it always to be right in the middle of the cluster. Sometimes it is. This one right here is a time price point of control. But take a look at where the volume point of control is. This is where all the activity was, but look at where the volume was. So this activity obviously propelled prices higher, because this is where we ended up closing. So this was buying activity. And then we had a lot of volume come in. And when this volume come in, we still managed to close towards the high. That should give us a clear bias to the upside. And this is evident in the following session when you see this buying tail and you see prices shoot right up. hopefully you're starting to begin to gain an appreciation for the importance of learning to read the profile and understanding what the development of the profile tells us. We will go through many of those examples, and we will visit a number of them together so that we can learn how to use that with skill in our trading practice. All right, so we highlighted earlier that this was just a time POC. This is where the volume point of control was, and they're not necessarily always in the same place, yet sometimes they are. In this case, both of them lined up perfectly together. And that does happen in the market, especially in what we would describe as a balanced session. Another important feature of the profile are the valleys and the peaks. And both of them are very, very important. Well, the peaks are easy to identify. They are these points that protrude out and have tiny tips like here. So here's another peak, and here's another peak. And obviously there's a peak here for this cluster and another one here. Well, why are peaks really important, and why do we care about them? Well, you can see from the profiles that from the profile that we are looking at that each of these peaks represent an area of great activity in the marketplace. And anytime there's been great activity, then I should be interested in that area, and that's an area of importance to me. At one point, after this activity has occurred, the market is going to do one of two things, and it's that simple. The market is either going to move higher or the market is going to move lower. So if I'm looking at a peak and I have a close that is higher than that peak, then I know that that peak must have been the result, or that activity must have been predominantly buying activity, and the buyer certainly was stronger at that peak. Now, when we come back to revisit this peak, the question that I have, as many traders do in the market often, is that buying activity still reliable? Are those same buyers that created that peak at an earlier point of time still aggressive and active and willing to step in and continue buying when we come to revisit that peak? And that's why they become important points of support and resistance in the market, and the market usually reacts to them, and that is why it is important and incumbent upon us to know where they are and to highlight them on our charts. Now we'll talk about the valleys. And the valleys basically are the opposite of the peaks. They are these points where there was actually very little activity in the market. These dips, if you will, valleys or dips, whatever you want to call them, but these points on the profile where we see little activity. Well, we just talked about the importance of the peaks and why they're important, because there was a ton of activity there. Now, on the other hand, when we have a valley, that's an area where the market basically rushed through it. The market really did not spend any time there. So obviously, if the market rushed through it and moved higher, that was an area of intense buying pressure. Since the buyers were so strong in that area, there was no need for the market to spend any time. It just sailed right through it, pushed higher, and continued to a level above. And that's why quite often these valleys become more significant when we're coming back down and testing levels of support. Because in some respect, these were actually stronger points of buying that sent us propelling forward or upwards, and now we are coming back to retest them. Whereas areas where we had intense activity or we had peaks, even though we did have a lot of activity and eventually buyers may have been dominant, there was obviously a lot of selling going on there too. But ultimately, the buyers prevailed. However, in these valleys, what we know for sure is that during that valley, for us to have moved higher, those must have been some pretty powerful buyers. And that is why they are very important levels as we drop back when the market is retracing or when the market is making a directional change. They are key levels that we look at to see how the market will respond when it returns for a revisit in those same price zones. Okay, another important feature that we need to be able to immediately identify on a profile, and we should understand the implications of it, are buying tails. And we will also talk in just a couple of minutes about selling tails, which are the exact opposite or the reverse of a buying tail. Now, if you take a look with me over here, down here, we've got a buying tail. During period A, this area in the session only had one period right through it. And the buyer was so strong that never again during this entire session did anybody have the ability or the wherewithal to penetrate and come into this zone or this area of the buying tail. The buyer protected it so tenaciously that it stayed on our chart as a buying tail, a period where there was no other period that was able to penetrate beyond this particular level up here. So period A was a long period, and B came right down through it, D came again, but never were any of the periods in the session able to get into this tail down here that we see on the lower end of the profile, making it an incredibly important price level or price zone, if you will. Now, why is that? Why is it so important? Well, it is very important because it tells us that we have a very strong buyer or group of buyers in this zone. And so I know now for a fact that the market is not going to drop any lower until that buying tail is traded through, or until a seller has the wherewithal to actually trade through that particular zone. Now, that did not happen here in this profile. We penetrated into it, but we were not able to trade through it for a while. Here we began to see some trading activity. So this was a powerful seller that overtook this buyer and thus was able to push prices lower. And we see a lower low here and some activity started to generate. So what happened then? Did the buyer vanish? No. What happened is this buyer actually now was able to buy at a better price. And so they began buying down here and pushed prices a little bit higher and higher yet, and the market continued to move higher yet again. So just because we overtake a buying tail does not mean that the buyer has gone away, and this is very important to understand, but it does mean that the prices will drop lower to test to see if the same buyer or perhaps other buyers are still interested at a lower level. Once we begin to see value develop a little bit lower and then start to push prices a little bit higher, we know that the buyers are still present in this zone and prices are likely to continue to push higher for us. Now, on the same chart, we also had a selling tail. And as I mentioned earlier, a selling tail is the exact opposite of a buying tail. It is a zone where the seller sailed through it unimpeded. Now, A period came back through this zone and tried to overtake the seller. It couldn't. More selling started to take place and it dropped prices. Notice where the close was down here. However, all this activity, obviously, some buyer was absorbing this selling activity, and that's why we didn't drop any lower. This is reaffirmed by another cluster in front of this cluster. So buyers are still absorbing what the seller has to offer. And now notice what begins to happen when we close a little bit higher. The clusters start to form higher and higher, and we take prices up. So looking at the profile of activity, looking at the clusters, looking at the values, looking at the peaks, at the features of the profile, where the selling tails are, where the buying tails are, helps us to identify where strong buyers are in the market and helps us to understand potential direction and which way the market is likely to move. And we are able to determine, and we know that simply from the market activity itself and the outcome of the activity. So whenever we look at a cluster of activity, the best way we can gauge what the end result of that activity was is by the ultimate outcome. And the ultimate outcome is, after that cluster, where did prices close? Where did we end up? Did we end up higher or did we end up lower? And that is, as simple as that is an incredibly powerful feature of the profile. Because when I look at any profile and I begin to see the evolution and the development of the profile, I am able to discern who was dominant during that session and where the potential direction of activity is based on the conclusion of trading in that session. So I begin to develop what we might describe as a bias for the next session. Now, certain things could happen in the following session that reaffirm my bias, and then if that's the case, I would trade in the direction of my bias. And we will talk about those philosophies and those methods when we begin tackling specific trading strategies. But before we can do that and begin to apply these concepts, what is incumbent upon us is to really have a coherent and clear understanding of these basic concepts and to be able to quickly read profile charts and sort of eliminate the mystery or the enigma that often surrounds the market profile. All right, another important feature on the profiles are areas of underdevelopment and areas of overdevelopment. Underdevelopment basically means areas where the market has not spent a lot of time, such as here. And once again, here, there's an area of underdevelopment. And once again, in the big picture, these areas of underdevelopment would show as valleys on the profile. And they are important again because the market sailed quickly through them. So since we sailed quickly through them, there was either a strong, powerful buyer present or a strong seller present in that zone. Okay, now let's take a look here. And now we want to examine a ledge. A ledge is another very interesting geometric feature on a profile. Now notice where we have areas here where we have an actual ledge down here, and then we have a close up there, and here we have a ledge that is sort of the opposite of the ledge down here. The ledge here really is a level of support. The ledge here is a level of resistance. Every time we tried to come up to it, we weren't able to move much higher, and it created a level of resistance, and we ended up down here with the close. The exact opposite. This was, in fact, a level of support, and we closed higher than that ledge. But ledges also help us to identify key levels in the market in terms of support and resistance. The single print. Minute yet incredibly powerful. When you see a single print on a chart, that is really a point that was only visited once, a single time price opportunity, and never again did the market ever come back to look at it or visit it. And that's why in the preference window on a profile chart in our trading platform, in the trading platform that all these charts are based on is Market Delta, there is a setting that allows us to identify all of these single prints. And they are so significant because we know at that point the market just simply, it's even more powerful than a valley, because a valley may have several points or TPOs that occurred through it. There just weren't very many, and it's an area of underdevelopment. A single print is the lowest form of underdevelopment. It was basically just one TPO, a single time price opportunity and no more. And the market just zoomed away from it. So if in fact the market zoomed away from it and moved higher, then obviously we have very strong buying pressure. And in this case, if you will quickly take a look at the profiles that we have, and we take a look at here, we closed higher. So this was obviously a single print that resulted from buying activity. The market sailed higher the next day. These types of hints or clues on the profile structure are invaluable. And you are not going to be able to see them anywhere else or on any other type of chart. Move on to the settlement period. All right. Every instrument at the conclusion of the trading session has a settlement period. If you happen to trade futures, and more specifically the ES Mini, the settlement period is usually identified as the last 15-minute period of the trading session. And you will often find that this period is a rather unusual period. You will see excessive volume that occurs during that period, certainly a lot more than the periods that preceded it. And it is a time when a lot of transactions take place. Some of them could perhaps be settlement, meaning people are settling positions that they may have had open during the trading session. That's where the name settlement comes from. And others could in fact be investors or traders that are taking positions or opening positions at the end of the day, and they're planning to hold them for a period of time. And so it could be a reflection of open interest in the market. And open interest means people who are willing to hold some contracts open for a prolonged period of time. So we know, again, that this settlement period, this short and brief period in the market, is a very significant time. And that's why it is worthy of our attention. And certainly we need to closely look at it, and we will in one of our lessons that's yet to come, and how we can use the information from that settlement period to help us prepare to trade for the following day. Now, every profile has a range, and the range is a basic concept that is not only doesn't only pertain to the profile, but certainly to any trading session or to any trading period. It will always have a range as well. However, it is very important for us to keep a close eye on the ranges of our profile and how the development occurs within the range. Where, in fact, is the greatest area of development, where the valleys are, and where the peaks are. This information is also very helpful in analyzing and understanding profiles. So as you can see from our discussion, there are a lot of key elements to the profile. And the more we know about the profile, the more we understand about the profile, the more information that we can extract from it. And this information then really becomes the bedrock foundation for our trading systems and our trading strategies. Now, here on this slide, I have a series of profiles, which I have labeled 1, 2, 3, and 4. Now, a useful tool in Market Delta and in most profile platforms is what's known as a composite tool. The composite tool allows me to create a holistic picture of a number of independent or separate profiles. So we can create what's known as a composite profile. So when I took together 1, 2, 3, and 4, this is the shape that I end up with. And notice how when I do a composite now, it makes it a little bit easier for me to gain better insight as to the development over the 4-day period. So quite often it behooves us to lump our profiles together and take a look at them as a composite to gain a more comprehensive and a better understanding of the market. And we will look at that technique again later in some of our future lessons. All right, now we are going to begin talking about some of our analytical tools in dealing with the profile. And this is rule 1 because it's a very basic rule that I hope you will always use and you will never forget. A profile should never be used in a vacuum, kind of as a standalone structure, because it isn't. A profile is part of the larger market structure, and it is part of a much bigger puzzle. And so I always have to analyze the profile in the context of the broader market. I can't be looking at it as sort of an independent or an isolated element in the market. No, it is an integral part of the overall activity of what's going on in the market. Now, I may slice it, I may dice it, I may look at different segments, different pieces of it, but ultimately, for my analysis to be accurate and thorough, I need to analyze the profile in the context of the broader market. And when I do that, I will gain much greater insight, and the information that I garner will be far more useful to me than if I look at a profile in isolation. So that is the thrust of our profile analysis, and that's why I labeled it as Rule 1. We always need to take a look at the broader market. Now, whether you are an intraday trader, whether you are a swing trader or a position trader, you need to look at the relative time frames that make sense for you. And even the intraday trader that is going to only hold a position during the day, they too should also be looking at the broader market and the higher time frames. So here in this particular chart, we have monthly profiles. And interestingly enough, we have 5 different months. The last month, of course, is the current month that we are looking at. And so as a result of the fact that we are very early in the month, we haven't had a chance to accumulate a lot of activity within that month yet. And so the range seems much smaller relative to the prior month. But there are a number of key elements that we want to always look at when we begin looking at monthly profiles or a broader market or a bigger market profile. We could also be looking at quarterly for that matter, bi-monthly. You could be looking at annual profiles if you choose to do so as well. For our purposes and for our course, we will be focusing on monthly, weekly, and intraday profiles. Now, we talked about the average range, or we talked about the concept of the range in general, but what is also important to understand is for every instrument and for every period of time, there is an average range, the range of movement from the low to the high. And that in itself tells us a lot of information relative to the instrument and helps our trading immensely. So for instance, the average monthly range for the ES Mini, the future contract, it's about somewhere in the neighborhood of 55 to 60 points in range. That's for the month. Now we could have some months that are a little bit higher than that. We could have some that are a little bit lower. And so when we speak of an average, it's just that. The first thing that the average helps us is to know where we are during the month relative to that average. Have we overextended the range? Are we yet sort of below the average, and so we have more room to move within the range? That in itself is a very important tidbit of information to keep in mind when you're trading during a particular month. So for instance, now in March, when we are looking at this last or the current month, the last profile on the chart here, there's really a lot of room for this monthly profile to develop to the upside or to the low side, because the range is much smaller than the average. And so we know that. And the key question will be, is it going to move higher? Is it going to move lower? But I bet you that many of you, just based on our first lesson today, would be able to take a look at these profiles and tell me what the bias is for this particular direction. It would not be hard to do that at all. And as a matter of fact, we will do that in just one moment. But let's take a look at what else the average ranges help to tell us and help us to identify. Whenever we begin to see a really broad range that's quite larger than the average, as we did during the month of February, we know that there is volatility in the market. And so knowing the average ranges helps us in a number of different ways when we begin to trade. So as a result of this volatility, we could probably expect some volatility in the month of March as well. Volatility has come into the market on a monthly basis, and it doesn't usually vanish very quickly. We can also see the volatility by virtue of the fact that the range for February actually pushed higher than the prior month and also lower. That's another indication when you see the range extend to the upside and also extend to the downside. That's another clear indication of market volatility. Now, another important point that we always need to look at is the midpoint of the range and the range factors. But before we talk about the range factors, I had asked a question a couple of moments ago. What is the bias? What do these profiles tell me? Well, let's begin first by identifying where these profiles closed. This one closed way up here, and this one closed down here, and this one closed here. The asterisk, of course, is what I'm looking for, and this one closed there. All right, so this one was here. We had a bunch of activity, and it pushed us higher, which meant that, in fact, we were heading to the upside. We ended up continuing within this same value area and then dropped down here and closed lower as a result of this activity. But if you notice, we closed right very close to the value area low, and we weren't heading really much lower. So what ended up happening is the following month, we dropped a little bit and we developed a cluster here. As a result of this cluster, we ended up with another one here, another small cluster, another one, and another one. Now notice what is happening with my clusters. They continue to move higher and higher, and another cluster, and then another really big cluster. Now we've opened this new month, and the question is, where is my bias? Well, if you notice, what did all this activity, all these clusters do to the price levels? It pushed them higher and higher and up. So the bias is actually quite bullish from the previous and the prior month. And I would likely expect prices to continue to move higher during this month. But because of the volatility, I should also be careful, because we identified the volatility in the market, that we're also likely to see some dips during the month, but followed by probably activity to the upside. That would be the prognosis or the outlook based on the profile structures that we see on our monthly charts. Now, back to the idea of range factors and the range in the marketplace. Well, we've already identified or defined what the range is, and that the range is really the price movement from the low to the high for a specific period in the market. And we talked about the monthly range. There is, of course, a weekly range. There's also a day session range. There's often an evening session range. So each particular session will have an average based on the period of time that you look at. Those are very easy to identify. You just look at a number of profiles, tally their ranges, and then divide by the total, and you'll get the average range for that period of time that you are looking at. Now, what is important is to understand the range factors. And what are the range factors? When we look at a range, we need to know where we're trading in the range. Are we trading a full range, of course, is from high to low. Half range is the midpoint. Quarter range is halfway with the midpoint between in the half, either lower half or upper half, and 1/8 would be the midpoint in the quarter range. Now let's go back and take a look at this chart that we examined, and we had identified the midpoints for each of those ranges. So the half of the range, and let's say for this profile that we are looking at, would be right here at this point. And the key question is now, relative to the past month, where are we trading? Are we trading, first of all, in the upper or in the lower half of the range? And obviously, we are trading in the upper half of the range. So already that in itself re-emphasizes the bullish bias that we had and that we discerned from the activity of the prior month. Now, let's take a look at quarter ranges. If in fact this is the half, and we look at the midpoint here, which would give me an upper quarter here and a lower quarter, all right? Where are we? We are in the uppermost corner. And the key question will be, will prices start to move lower into the lower quadrant here? Or if we were to break up the whole session into 4 quarters, this would be 1, this would be 2, and this would be the number 3, and this would be number 4. So are we going to drop into the 3rd quarter, or are we going to continue and move higher beyond and above the 4th quarter? When I track and I take a look at the movement, if in fact we are in the 4th quarter and moving higher, that re-emphasizes my bias to the upside, and I should be looking for long entries. If, on the other hand, prices are dropping, and even though I'm still in the upper half, potentially I could be coming back for a retest of the midpoint of the range. Now, if in fact we're not able to hold the midpoint of the range, you can expect prices to continue to drop lower and lower for a retest of the 2nd and the 1st quarter. And this is why the range factors are very, very important. You need to always know, relative to the prior month, where are you trading in terms of the range factors, in the upper quarter, in the upper half, or in the lower half. So we will also be applying and using this concept in developing and determining our biases for each trading session before we begin to trade. All right, so those are factors. All right, so what does the data tell us about market sentiment, and what do we mean by market sentiment? Well, market sentiment is nothing more than telling us whether there are buyers in the market and there is a bullish sentiment, or whether the predominant force in the market is bearish and that in fact the sellers are supplying the market and they can overtake the buyers. So when you hear those phrases, that's all they mean. The sentiment is really just about who is the dominant force in the market. Is it the buyers or the sellers? And the profile helps us with that by really showing us, as a result of the activity, the clusters or the valleys, if you will. Where do prices end up moving? Do they end up moving higher, or do they end up moving lower? That's one way. Now, that's not the only way. The value area also helps us to a large extent understand a lot of information about the sentiment or the dominant force in the market. Typically, we'll take a look at where the value area is relative to the prior month. And in this case, you will see that the value area for this month is above the close of the prior month, which is again a very bullish bias, or bias to the upside. Not only that, we have a higher high and a higher low on the range from the prior month. All these are very bullish indicators on the market. Now, moving back again into our current picture and what's going on in the market currently, these are weekly profiles for the time period that we happen to be in. So if we take a look at the dates below, this was for the week of February 9th, 16th, 23rd, and here is the first week in March. So let's take a look now and see what these weekly profiles tell us. If you notice, the clusters here continue to move higher and higher. So obviously the bias is to the upside. We've also not created a lower low from the prior week. So but we also haven't made a higher high yet. But this is still early in the week, but definitely my bias is to the upside. Look again, the valleys. Hardly spent any time here, hardly spent any time here. And the prices are moving higher and higher to close at the very peak near the high. Now, once again, we dip a little bit lower. We come back to this area that was the volume point of control right here, and we're still in the upper half of the range of the prior week. Notice here's my half mark, here's the upper range. So we never actually get into the lower range of this week. We're still in there. So once again, another bullish week. Same thing happens. I have this next week here. Here's my midpoint. Now notice the penetration of this week into the week before. We never penetrated anything below the upper half. Bullish again. Here again, we begin in the lower half of the preceding week, and we have yet to see, are we going to start moving higher, or are we going to in fact move lower? At this point, because the close is right here, we are still, our bias is still to the upside, and we anticipate things will continue to move higher because look, again, as a result of all this activity, we are up here, certainly above the midpoint of this particular week, but we haven't yet overtaken the midpoint of the prior week. However, I don't expect the market will have much difficulty in doing that, and we are likely to see prices continue to move higher and higher. All right, the clusters again, just track them and you will be able to get a great idea about what's going on in the market. So we looked at the monthly, we looked at the weekly, and now this is a 24-hour period profile. Earlier, I showed you profiles where we were able to split the evening and the day session. But what happens when we actually combine the evening and the day session together? We get what are 24 hours. So this is a sample of an actual 24-hour profile for the ES Mini. In this case, we closed on the high. The cluster here in the evening created an up movement, and notice we weren't really able to sustain it much higher. We came back and we closed above the value area high, but we weren't able to sustain that on the following day. We actually gapped down and prices dropped, yet the buyers stepped right in, and look at the cluster that was created during this 24-hour period, and the next cluster above it is heading higher, and I would anticipate prices to continue to move higher again. Now notice how the different charts and the different time periods correlate together, and they all really point to the same thing. once you learn to read the profiles, this will help you create your bias for the trading day, and then the actual new activity will either affirm or negate the bias that you may have developed. All right, with that, we will conclude our session today. And as usual, I will invite your questions via email and answer them via email. I find that is the best way to answer them thoroughly, and that way we keep the time of our session for the actual lesson. With that, I will wish you luck, and I will see you on the next lesson.